Hey folks, Dan Freer here, the rate update. Today is August 27th, 2020. I'm a little flustered today, so bear with me. Why? Well, Federal Chairman Powell came out and spoke and basically threw us a complete curveball. I didn't expect this, and I don't think a lot of economists expect it. So that's what we're going to talk about next. Okay, so the news that the Chairman Powell came out with today was basically this. What they usually try to control, or the Federal Reserve, their focus is they're trying to rein in or control where we are with inflation. Inflation is a deteriorating factor for our monies in the U.S. So, as the higher the inflation rates go, that means the more money we're paying for stuff. And that is the biggest kind of kryptonite for mortgage bonds and all bonds. So let me explain to you what's going on. The Fed came out and said, okay, instead of trying to keep inflation intact, meaning we want it to be maxed out at 2%, and we haven't been there in a long time. But they came out and said today, we don't really care what inflation does as long as it averages 2% over a term. And that term really wasn't specific. So what they mean by, like right now, inflation rate is running about 0.9, okay? That means if you take that figure today, we can actually get to 2.9% in inflation before the Fed even blinks. It might not sound like much to you guys, but it's throwing havoc in the bond market. And so let's see what's happening in the bond market right now, specifically mortgage-backed securities. So those that follow me every day, you know that I follow mortgage-backed securities. What this is a bond that trades as an investment. And it's a cluster of mortgages thrown into a bond, and you can buy those as investments, okay? This is what's happening to the price of the bond, the mortgage-backed security, MBSs, all right? So as the price, you pay less for a bond, that means the rate of return is higher, meaning the interest rate or your mortgage rate is higher. This is a pretty big move. Okay, so we love when it's green, because when it's green, you're paying more for a bond, thus, in turn, getting a lower rate of return, thus a lower mortgage rate. Okay, so it's basically an inverse relationship. We love green. Green is good. You pay more for a bond, brings down the rates. We hate red. It means you're paying less for the bond, increasing the yield of that bond or the mortgage rates. So the levels that we've been hitting, and this is where I've been focusing on, and this is why we locked everybody up here. Unless you have a brand new application in with us, you're locked in. What happens is all these lines, this line here, this line here, this line here, these are called Fibonacci levels. This is a ceiling, a floor, short-term floor, long-term floor, okay? So we should be trading, mortgage-backed securities should be trading in this range, okay, in a normal market. We aren't in normal markets. But that being said, we have to follow trends to figure out where the future is going to be, is the best way to put it. Well, we had a short-term ceiling right here that I was following, and we kept hitting that ceiling and stopping and hitting and stopping and hitting and stopping. When we broke out of it, I said to all my loan officers, I said, guys, lock in, because I got a feeling we're in for a little bit of a bumpy ride. We locked everybody in right in this duration here. Okay, again, the higher this is means the lower your rate. Don't think this isn't rate, this is price. This is a chart of the price. So as it's going up, we're getting lower rates. As it goes down, we're getting higher rates. So right in this area, we locked basically everybody we had. And what I was saying is we kept hitting this ceiling and bouncing back. And I said, okay, that's going to be a resistance level that I got a feeling that we're going to have a tough time surpassing. following other trends that I follow. So then the next trend lines I'm thinking or watching is 25-day, 50-day, and 100-day moving averages. And these are the lines through here. So where those come into play, those also create short-term, mid-term, and long-term kind of trend marks of where we should be trading. So at the time we were in here, I'm thinking, okay, the rates should most likely be in this range here. Okay, we got there basically in a day. Thank goodness we locked everybody here because we had a pretty big bump in rates right through this region here. But then we started hitting resistance again. We hit it here, 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 and I'm thinking, oh boy, here we go again. We had another head and shoulders chart, meaning here's the head right here. We had a shoulder here, and we dropped past it. So I'm thinking, geez, here we go again. We're going to have another downturn. And what I said is the downturn should be most likely our 50-day moving average. Well, we hit that today. So if you go back to watch my videos for the past 2 weeks, I predicted all of these moves, unfortunately. And I wish I was wrong. I wish we were up here. That means rates would even be coming lower. So now we have a resistance level right here. So we shouldn't really be moving much further, but who knows? That's the tough thing, and that's why I monitor this. If I showed you my desk, I have one specific monitor that does this all day long, tick by tick by tick, so I can keep in tune on what's going on with the market. So what's happening is the Fed came out and said, we don't really care what's going on with inflation. We'll let the economy run hot. We're going to be more in focus or in tune of the employment and GDP and some other factors. Well, that kind of scared the markets because inflation is the biggest detractor for bonds. Because if we have high inflation, nobody wants to get into bonds because the yields aren't as high. And so if inflation hits 2 or 3%, you're only getting a 0.5% yield on a bond. Well, you're losing money basically in that investment. So that's the easiest way I can put it. So Federal Chairman Powell came out and said we're going to now change our focus to an average inflation targeting. They used to have a 2% target for inflation. Now they're saying they want to average it at 2, meaning if we're at 1% right now, and their average target is 2. I said that on purpose. Average target is 2. Means we can go to 3, and we're still averaging over the term they're looking at is 2. If you get what I'm saying, if we're at 1 now, we can go to 3, and that average would blend to 2. Well, if we hit 3% inflation, you're going to see rates skyrocket with mortgage rates. Now, what a lot of people don't really understand is the Federal Reserve, they control the federal funds rate. They do not control mortgage rates. What is the federal funds rate? Well, the federal funds rate is actually interbank lending. So if you're a bank at the end of the day and you need to keep certain reserves, let's say I need $100 billion in reserves every night before I close the doors in reserves to be solvent, and I'm short. Well, I go to the Fed window and I borrow money or borrow it from some other entity, some other bank, and the federal funds rate is the interest rate that I have to pay for that reserve money to make me whole overnight. So that's the best way to explain that. So the Federal Reserve does not, period, control mortgage rates. So that being said, here's some of the things that the Fed is monitoring on a diligent basis. They want to see inflation or average inflation at 2%. They're watching employment. They're also watching the growth rate of the economy, manufacturing and production. And again, they don't control mortgage rates. So where are we with some of these things if we go through it? Well, inflation's in check. We have no problems with inflation. The employment numbers came in today, and that's throwing us for a train wreck right now. The employment numbers prior to the pandemic were basically the best that they've been in over 50 years for all sectors. No matter white, black, Mexican, Chinese, whatever, everybody's employment factors were basically the best they've ever been, or at least for 50 years. The GDP, our GDP growth was fantastic. Then all of a sudden, Corona hit. And now here's some of the numbers that we see. This is basically talking about the inflation and how that deteriorates from the economy. But right now we have unemployment. Unemployment, theoretically, when you add in everybody out there that's filing for unemployment, even those under the pandemic unemployment assistance, those are basically people that would normally not get unemployment that are getting it now based on the CARES Act and some other things. Our unemployment rate is basically, it's saying 16.5, let's say between 15 and 20. That's terrible. Then you go to our GDP, the growth of the economy. We did better than expected, but we're still down 31%. And it was expected, the last indicator was down 32.9. So, I mean, all that is terrible. So what I'm getting at is I think the news is going to get digested tonight. We are down big with mortgage-backed securities, but I think all the information is going to get digested tonight, and we're going to have a recovery tomorrow. I don't know if we're going to pick up all the way of everything we lost today, but I think we're going to have a nice little recovery tomorrow with mortgage-backed securities. Another thing is the stock market is hitting record highs every day. So more and more people are pulling out of bonds, putting it into the stock market. Now, my feelings on the stock market, and I have a degree in economics. I actually moved to Chicago to be a trader. Never did that, but that still was my passion, and I watched that meticulously. I think, as well as a lot of other people right now are saying, take some money off the table. And I told you guys this before this pandemic hit, and if you did that, you were good. And it give you an opportunity to jump back into the market. Right now, pull some money back off the market. The technology is tearing it up. Tesla, for example, it's up 900% this year. Take some of your money. Take your profits off the table. Let the rest of it ride. Then if you lose some money, it's your initial investment. You already took all your profits out. Take your initial investment out and just play with house money. Best way to put it. And then if it goes up, you're playing with more house money. If it goes down, you're at least safe a little bit. So that's what I'm saying or advising people to do in the stock market. Mortgages, I am a proponent of if I get a reprieve tomorrow, I'm going to be locking people in because we're in uncharted territories. The good news is the Fed keeps buying and buying and buying and buying, and they're buying about $5 billion in bonds a day. So that's why I also think this is going to recover because we had a lot of selling today, probably by individuals. The government is still, or the Fed's still jumping in, buying their portion of it. So once we get the individual traders out and just have the Fed in there buying, this will stabilize things quite a bit. So let's get on to some other news. Economic calendar for today. Jobless claims, where we're up a little bit than expected. Well, this is hard to watch because it's like, I'll leave it at that. Gross domestic production, like I said, the consensus was 32.5. Last month we were at minus 32.9. We came at 31.7, which was better than last month and the consensus. What else? Initial jobless claims. Let's see where that is. About the same. So that's that. Pending home sales. This is an area it's double what the consensus was. Double. So housing is still tearing it up. So if you're looking to buy, you're looking to refinance, whatever, don't put it off. I think we're in unprecedented territories, and I apologize. I didn't show you my screen when I was going through the calendar. I'll go through it real quick. Jobless claims was higher than expected, but it's still not bad. It was better than last month. The area where I was saying is actual housing sales, they doubled what the consensus was. And that's where we're at. So I apologize. I didn't change screens on that. Tomorrow we have some different things coming out. These shouldn't really affect anything at all right here. Some of the headlines I'll be posting here shortly is don't be fooled by today's mortgage rate news. Again, what I've been trying to tell you guys is a lot of the media, they study mortgage rates that were 2 weeks ago, say Monday and Tuesday of last week, compared to where the rates were Monday and Tuesday of this week. And then usually Wednesday, Thursday, Friday, they come out with all their articles. So you might see a lot of ads saying, hey, rates are at a record low again. Well, you can say to somebody, and if you talk to somebody that says that, you can say, well, if you follow Dan, you know that we got killed today. So this is not priced into the media or the mainstream media news. I'll zoom this up so you can watch this. But that's basically what this says up here. Rates are lower today than they were yesterday. That's wrong because it's basically they're giving you data from last week. And then when the Fed announced their news is playing havoc on the markets. I think that's it for today. That is it. So my assumption on all of this, to put it in a nutshell, we should stabilize. I think the individual investors are out. Federal Chairman Powell spooked the markets enough, but I think once everything gets digested, we will be just fine at these levels. So if you'd like my help with anything, all I ask you to do is go to therateupdate.com. Therateupdate.com. You can reach me personally by calling 844-775-LOAN. That's 844-775-5626. Follow me on all this social media. I post every day on all of this stuff. If you want to reach me, best way to get me is my name is Dan Frio. Best way to reach me is D for Dan Frio, which is Frio at preferredrate.com. What I ask people to do is if you're in the process of getting a mortgage right now and you want to see or get a second opinion on what I can or can't do for you, send me a copy of what we call the loan estimate or your fee worksheet. And all lenders have to do that. Sometimes it's tougher than others. Like in our system, doesn't really allow me to create a loan estimate without you applying for the loan. So I can get some of your basic information, put it in the system, and get you a fee worksheet the best I can. But just so you know, if somebody quoted you on Monday and you didn't lock, get a new estimate because your rate's going to be higher than it was Monday. I can promise you that. So if you need a second opinion on those, please email me that loan estimate that you receive and say, Dan, what can you do? And I get probably 5 or 10 of these a day. 99% of the time I can win. So that's that. If you're looking to buy a house, all you have to do is go to the website, hit home purchase qualifier, fill out as much as you can. We'll be back with you. If it's during office hours, we'll be back with you within an hour to kind of pick your brain a little bit, see exactly what you're trying to do. No hard pressure sales. We're just trying to work with you on this. We'll tell you what we can or can't do for you, and then we'll leave it up to you if you guys would prefer to work with us or not. I hope you choose that you do. If in the meantime, if you would, please don't forget to give me a thumbs up. I'd love to get that from you. Please subscribe down below. Hit the bell in case I do post a new video. You get alerts of that. I'm trying to hit 10,000 subscribers by the end of the month. Don't know I'm going to do it. I'm about 400 short and I need your help. So only you guys can help. So please give me a thumbs up, share, do everything you can. And I greatly appreciate you watching me. Sorry it was a long one today. I wanted to talk about what the Fed was doing, at least giving you guys my opinion on where the next short-term little run is going to be. And I think we should be stabilizing at this point. So God bless. Take care. Have a good night. Be safe.